Welcome back to Inside the Wall. In this episode, we decode the signals hidden inside the earnings calls of three seemingly unrelated companies, Micron, Nike, and Carnival, to reveal what they're telling us about today's bifurcated economy, the rise of the AI supercycle versus a broader consumer reset. First quarter 2026 earnings calls reveal a sharply bifurcated economy. In technology, the AI build-out is driving demand well beyond supply, giving companies strong pricing power and record margins. On the consumer side, the picture splits further. Spending on services and experiences remains resilient, allowing companies like Carnival to push pricing to historic levels. But consumer goods are in reset mode, with firms like Nike facing regional softness and margin pressure from tariffs. The takeaway is clear. This is a late-cycle environment marked by sector rotation, where capital is flowing toward areas with durable, secular growth. Recent earnings calls Micron, Nike, and Carnival reveal an economy defined by divergence, not uniform growth. Demand signals show a clear bifurcation. In technology, companies like Micron report AI-driven demand far exceeding supply, fueled by a multi-year data center build-out. In consumer services, firms like Carnival are seeing record bookings at historically high prices, showing resilience despite weak sentiment. But consumer goods tell a different story. Nike's results highlight strong North American demand alongside sharp weakness in China. The takeaway is a fragmented economy, structural growth in AI, selective strength in experiences, and a reset underway in consumer goods, with pricing power concentrated where demand is most durable. Looking at sector signals, key observations show strong demand in semiconductors driven by AI. Travel services exhibit record bookings. Consumer goods, however, show regional divergence, highlighting that growth is sector-specific, not broad-based. Pricing power is one of the clearest signals of corporate resilience, and recent earnings calls show a sharp split. Micron reported roughly a 20% jump in memory prices and has already locked in pricing and volume for all of 2026 HBM supply, clear evidence of AI-driven leverage. Carnival is also pushing prices to historic highs, with management citing ample room to go higher. Nike, by contrast, is discounting in weaker regions like China, where its premium positioning has eroded. The takeaway is that inflation today isn't broad-based, it's sector-specific, concentrated where structural demand overwhelms supply, and absent in industries still undergoing cyclical resets. Similarly, margins tell you who's in control of their business. Q1 commentary shows a clear split. Micron guided to a record 68% gross margin, driven by AI-driven pricing power and strong execution in a supply-constrained market. Carnival contained inflation, holding unit cost growth to about 2.5%, and delivering its strongest operating income per berth in nearly 2 decades. Nike, however, is under pressure, facing inventory write-downs in China and significant tariff headwinds. The takeaway is that margin expansion today is structural for AI-exposed companies, cyclical for services, and constrained for consumer goods still in reset mode. The nature of costs varies. Micron's expansion is structural, driven by the AI supercycle. Carnival's recovery is cyclical, enhanced by operational efficiency. Nike's strategic reset involves navigating tariff impacts and inventory cleanups. In capital confidence and strategy, Micron is pursuing aggressive expansion with $20 billion capex for HBM. Carnival is focused on balanced growth, deleveraging, and upgrades. Nike is undergoing a disciplined reset with an emphasis on operational efficiency. Balance sheets are shaping strategy, and Q1 earnings calls show a clear shift toward financial repair. Micron generated record free cash flow, paid down debt, and returned to a net cash position. Carnival hit a major milestone, reaching investment-grade leverage after cutting more than $10 billion of debt. Nike, meanwhile, is focused on rebuilding margins, rather than managing balance sheet stress. The message is consistent. For strong operators, financial conditions are no longer a binding constraint. Cash flow and disciplined deleveraging are offsetting higher rates, turning balance sheets from headwinds into strategic tailwinds. Putting all the signals from these three companies' earnings call together reveals a complex but consistent macro picture. The economy is clearly split. AI-driven technology is in a structural boom with exceptional demand and pricing power, while consumer goods are in a reset marked by regional fragmentation. At the same time, the experience economy remains resilient as consumers prioritize services over goods. This isn't a single-cycle story of expansion or recession. It's a late-cycle environment defined by pervasive sector rotation, where capital is flowing decisively toward areas with durable secular tailwinds, most notably AI. Thank you for watching Inside the Wall. Leave a comment for any questions.